Hey guys, welcome to the Bitcoin Fortress podcast, helping you increase your financial freedom. This is episode 115, recorded a little earlier this week on May 10th, 2024. This podcast is for entertainment only, not investing advice, so as always, please do your own homework. So we'll start with a abbreviated market update this week since markets aren't closed. Since we're recording this here on Friday. For the week of, and this is from May 6th through the 9th, the U.S. stock market showed positive movement. The Dow Jones Industrial Average saw a modest gain, ending slightly higher than the prior week. S&P 500 and NASDAQ also demonstrated resilience, recovering from minor losses earlier in the week and moving upwards. This week's performance was influenced by a mix of corporate earnings reports and economic indicators, which seemed to bolster investor confidence despite some underlying economic uncertainties. In terms of broader market trends and outlook, the election year dynamics are playing a subtle role so far. Historical data suggests that the U.S. stock market performance in election years does not drastically differ from non-election years, though the journey there can vary. Interestingly, there's currently a low percentage of companies mentioning the election in their earnings calls compared to past cycles, possibly due to the well-known nature of the likely candidates, which may be reducing uncertainty. Overall, while politics continues to be a backdrop, market performance is more heavily influenced by other factors like interest rates and corporate earnings. Investors might find opportunities in segments like green technology, depending on political developments, and sectors like healthcare, which currently shows less political risk. All right, jumping into this week's top Bitcoin news. First up is from CoinDesk. This was posted on May 9th. Bitcoin miner Marathon Digital misses Q1 revenue expectation on operational challenges. Marathon Digital, one of the largest Bitcoin miners, missed consensus first quarter revenue expectations due to operational challenges it faced during the quarter. The company mined just 2,811 Bitcoin during the year's first 3 months, down 34% from the prior quarter. Bitcoin production and therefore revenues generated during the quarter was negatively impacted by unexpected equipment failures, transmission line maintenance, and higher than anticipated weather-related curtailments at Garden City and other sites during the quarter, the company said in a statement on Thursday. Marathon reported first quarter earnings per share of $1.26, at first glance easily topping Wall Street estimates of 2 cents, but not comparable to forecasts as the company adopted newly approved FASB fair value accounting rules. The mark-to-market adjustment was a very favorable one given the big run higher in Bitcoin prices. The miner is sticking to its 2024 guidance of ramping up to 50 exahash per second and sees additional growth in 2025. Marathon stock fell roughly 1.5% in post-market trading on Thursday. Shares have declined 26% this year, while peer Riot Platforms has seen its stock price fall 40%. And again, just like gold miners, Bitcoin miners tend to be highly leveraged to the Bitcoin price. So they go up faster than Bitcoin when Bitcoin's going up, and they drop much more when Bitcoin drops. Next article is from Bitcoin.com. This was posted yesterday. Trump attacks Biden's crypto awareness, says Biden doesn't even know what it is at an NFT gala. At former U.S. President Donald Trump's NFT event on Wednesday, he urged the crowd of cryptocurrency advocates to support his candidacy, emphasizing the importance of their votes. The occasion was a dinner gala celebrating Trump's Mugshot Edition NFT collection. When questioned about accepting cryptocurrency for campaign donations, Trump confidently assured he would facilitate it. "If you can't, I'll make sure you can," Trump declared to the attendees. He was informed that many crypto businesses were relocating offshore due to stringent regulations. Trump responded firmly, "Well, stop it. We don't want that. We're going to embrace it," his voice rising above the noisy gathering. Additionally, Trump criticized President Joe Biden, claiming the current president is unaware of the nuances of cryptocurrency. Trump criticized the Biden administration's stance on cryptocurrency, stating, "Democrats don't like it, and Biden doesn't even know what it is," while mockingly imitating the current U.S. president as if he was oblivious of his surroundings. He highlighted the diverse nature of cryptocurrency and asserted, "If you are in favor of crypto, you better vote for Trump," he declared. At press time, Trump's campaign website does not accept cryptocurrency, only allowing contributions through Apple Pay and credit cards. So, we can't trust politicians, but it doesn't hurt when they get behind. I wouldn't say crypto, I would say Bitcoin, but obviously Bitcoin gets lumped in with that. Next up is from Cointelegraph. This was posted on May 8th. House votes to nullify SEC's anti-crypto banking guidance, SAB 121. The United States House of Representatives has voted to pass a bill overturning controversial Securities and Exchange Commission guidance preventing banks from owning crypto. President Joe Biden, however, warned earlier in the day that he would veto the new bill if it were to make it to his desk. On May 8th, the House voted to pass a bipartisan bill titled HJ Resolution 109, overturning the SEC's Special Accounting Bulletin 121, requiring banks to hold their customers' crypto assets on their balance sheets, which is not the case for traditional assets such as securities. Republican Party Representative Mike Flood, who introduced the resolution, said SAB 121 was unfair for banks looking to custody crypto, as custodial assets are always considered off balance sheet. Notably, 21 members of the Democratic Party voted in favor of the bill, which combined with the 207 votes from Republicans saw the bill pass 228 votes to 182. Despite the bill passing in the House of Representatives, President Biden said he would veto the new bill. In a May 8th statement, the White House said it strongly opposes members of the House of Representatives looking to overturn SAB 121, claiming it would disrupt the SEC's efforts to protect investors in crypto asset markets and safeguard the broader financial system. And this is a quote, "Limiting the SEC's ability to maintain a comprehensive and effective financial regulatory framework for crypto assets would introduce substantial financial instability and market uncertainty." Introduced by the SEC in March 2022, SAB 121 outlines the regulator's accounting guidelines for institutions looking to custody crypto assets. Notably, SAB 121 virtually prevents banks from custodying crypto assets on behalf of clients. U.S. lawmakers, as well as SEC Commissioner Hester Pierce, have argued SAB 121 jeopardizes the willingness of regulated banks to act as crypto custodians and treats crypto holdings differently than other assets. By overturning SAB 121, the bipartisan resolution ensures consumers are protected by removing roadblocks that prevent highly regulated financial institutions and firms from acting as custodians of digital assets. The House Financial Services Committee said in a May 8th statement. Staff Accounting Bulletin 121 is one of the most glaring examples of the regulatory overreach that has defined Gary Gensler's tenure at the SEC, said HFSC Chairman Representative Patrick McHenry. Next up from Decrypt, posted on May 10th, Bitcoin price is again dictated by Fed policy, according to an analyst. Now that Bitcoin ETF hype has died off, the price trajectory of the leading crypto asset is back in the hands of the Federal Reserve, a new analysis suggests. In a Friday report, European digital asset manager CoinShares said Bitcoin's price movements again appear driven by the broader interest rate conversation. A closer examination of the last 40 trading days reveals an increased alignment with the interest rate expectations for June, wrote CoinShares head of research James Butterfill. A similar trend was observed in 2023. According to CME FedWatch, the market appears certain that interest rates will stay flat until June, only potentially dropping in Q4 this year. Core PCE inflation, the Fed's preferred inflation metric that excludes food and fuel, has proven much more sticky than expected over the last several months, remaining flat at 2.8% in March. Conversely, GDP growth figures have proven underwhelming, recording 1.6% in Q1 2024 as compared to 3.4% in the prior quarter. Data also shows that growth in the manufacturing and services sectors are contracting and stalling respectively. Such metrics fuel fears of stagflation, raising expectations that the central bank will keep rates higher for longer. In response, CoinShares explains Bitcoin's price fell below 57,000 leading into the Fed's next meeting on May 1st. While the central bank maintained its policy rate above 5.25%, however, it also announced a dovish surprise with plans to taper its quantitative tightening. This would mean reducing its balance sheet by $25 billion per month rather than its prior $60 billion rate, slowing the rate at which it contracts the economy's dollar supply. Theoretically, that's good for Bitcoin and other risk assets, which have previously thrived in easy money macro environments. Bitcoin's price recovered above 60,000 shortly after the Fed's announcement. Keeping front-end rates elevated while simultaneously tapering QT can be likened to both applying the brakes to a car and accelerating at the same time, Butterfield wrote. The U.S. Treasury, he added, may be reaching its limit in paying off its short-duration debt, leaving a shift in the Fed's QT strategy as the only remaining option. Butterfield expects the Fed to cut rates later this year in response to weaker economic data, with the cut likely being late but greater than expected. With Bitcoin's fixed supply and high immutability, when the Fed eventually cuts rates, it's probable that this tumultuous situation will support Bitcoin prices, he added. Okay, next up is from bitcoinnews.com. This was also posted today. Bitcoin sharks engage in aggressive buying spree, according to Willy Woo. Bitcoin's market dynamics are showing signs of intense activity as on-chain data reveals a surge in accumulation by high net worth investors, commonly referred to as sharks, holding between 100 and 1,000 Bitcoin. Analyst Willy Woo has shed light on this trend, emphasizing the significant increase in Bitcoin supply held by these investors over the past 2 months. Woo shared a Glassnode chart showing increased activity by Bitcoin sharks. The data suggests that despite Bitcoin trading at high prices, these investors have engaged in aggressive accumulation, surpassing any previous buying phases observed from this cohort over the past few years. Even when compared to historical streaks, the scale of this latest rise stands out. It's important to note that the data reflects entities, not individual addresses. Glassnode defines an entity as a grouping of addresses belonging to the same investor. This approach provides a more accurate representation of the market as some investors diversify their holdings across multiple wallets. While transactions between an investor's addresses may not affect the wider market, they are considered buying or selling when looking solely at addresses. However, some in the Bitcoin community have expressed skepticism regarding the nature of this accumulation. Concerns have been raised about the suddenness and magnitude of the increase, with suggestions that it may be influenced by factors such as ETFs or custodial entities. Renowned on-chain analyst James Check has pointed out anomalies in the data, attributing the sharp rise to factors other than organic investor demand. He's stated, I'd say that chart would be largely measuring coins going into the smaller size spot ETFs. It wouldn't include IBIT and FBTC, but many of the UTXOs and the smaller ones will fall in here. Vertical jumps like that are not normal and usually some kind of anomaly. In response to these concerns, Willy Woo argued that ETF inflows alone cannot account for the significant increase in Bitcoin supply held by these entities. He highlighted the need to consider other factors and stressed the importance of quantitative analysis in understanding market dynamics. According to Woo, the influx of funds into the Bitcoin network far exceeds ETF inflows, indicating genuine demand from investors. Despite the skepticism, Woo remains bullish on Bitcoin's outlook, emphasizing the long-term implications of accumulation by high net worth investors. He suggests that while price movements may not immediately reflect this accumulation, they are likely to create a supply shock, stating, price will rally when the market is impatient, but for patient accumulation, the price does not need to move immediately. But eventually, if sufficient accumulation happens, price rallies afterwards due to a supply shock, so it's not bearish at all. While some view the recent accumulation by Bitcoin shark entities as a bullish sign, others remain cautious, citing anomalies and alternative explanations for the observed patterns. Okay, next up is from the Crypto Potato, and this was posted on May 10th. A little bit more on Bitcoin price. Here's when Bitcoin price will skyrocket to $1 million, according to Jack Dorsey. In a May 9th interview with journalist Mike Solana on Pirate Wires, Twitter co-founder Jack Dorsey shared his bullish view of the future price action of Bitcoin. Dorsey told Solana that he believes the cryptocurrency could soar to at least $1 million by 2030, stating that there is a high probability it hits that number and goes beyond. Dorsey highlighted that beyond Bitcoin's price, the most captivating aspect lies in its collaborative ecosystem, where individuals are incentivized to contribute towards its improvement. He emphasized that anyone involved in Bitcoin, whether through work, payment, or investment, enhances the overall network, thereby driving its value higher. According to him, this dynamic makes Bitcoin more than just a financial asset. It represents a compelling ecosystem and movement that has provided valuable lessons. Dorsey had previously expressed his grand vision for Bitcoin's potential societal impact, suggesting that he sees it as capable of contributing to world peace and energy abundance. During the interview, Dorsey, who now heads the financial services firm Block, offered insights into his recent departure from the board of Blue Sky, a decentralized Twitter alternative he co-launched in 2019. Blue Sky officially confirmed Dorsey's exit via a post on May 5th, expressing gratitude for his role in initiating and funding the project while announcing the search for a new board member. In discussing Blue Sky, Dorsey expressed concerns about its direction, stating that it was literally repeating all the mistakes Twitter made and asserting that it lacked true decentralization. He expressed dissatisfaction with Blue Sky's deviation from its original vision as an open source protocol separate from specific applications, emphasizing its shift towards traditional company structures and moderation tools. Initially conceptualized as a protocol that Twitter and other social media platforms could use independently from the application layer to mitigate censorship risks, Blue Sky's transition into a more corporate entity with investor backing and governance contradicted Dorsey's intentions. Everything we wanted around decentralization, everything we wanted in terms of an open source protocol suddenly became a company with VCs and a board. That's not what I wanted. That's not what I intended to help create, he said. Dorsey, who has since removed his Blue Sky account, remarked that the platform Nostr, characterized by its anonymity and open protocol free of corporate or centralized authority, better resonates with his principles of censorship resistance. And I totally agree. I love Nostr. It's great. Okay, next up is from BitcoinNews.com. This was posted today. Lightning Labs announces stablecoins on Bitcoin Lightning Network. Lightning Labs, led by CEO Elizabeth Stark, is pioneering the integration of stablecoins onto the Bitcoin network. This development promises to enhance accessibility, security, and affordability in the realm of digital assets. Stark unveiled this revolutionary initiative at the Crypto and Digital Assets Summit hosted by FT Live in London. Emphasizing the significance of this milestone, Stark remarked, "The idea is to have crypto dollars and stablecoins on the Bitcoin blockchain. This bold vision represents a paradigm shift in the utilization of Bitcoin, transcending its traditional role as a speculative asset. At the core of this innovation lies the Taproot Assets Protocol, meticulously engineered by Lightning Labs. Through relentless efforts, developers have made strides in testing this protocol on the Lightning Network," Stark proudly declared. "We released an early part of the code in October and recently demoed the first ever transaction on Lightning of an asset." Stark champions Bitcoin as the official or as the optimal platform for hosting stablecoins, citing its unrivaled security and decentralization. Traditionally, stablecoins have operated on alternative blockchains fraught with exorbitant fees and operational inefficiencies. Stark's conviction in Bitcoin's superiority as a host platform underscores a seismic shift in the digital asset landscape. The onset of the COVID-19 pandemic catalyzed a surge in stablecoin adoption, particularly in emerging markets, Stark elucidated. The stickiest users have been those looking for a stable store of value. In some cases, they're using Bitcoin. In other cases, they're using stablecoins. And in some cases, it's a combination of both. This trend underscores the growing demand for stability amidst economic volatility. Stark envisions Lightning-powered stablecoins as a catalyst for financial inclusion, offering a lifeline to individuals grappling with hyperinflation and economic instability. By democratizing access to stable store value assets, this initiative has the potential to uplift millions worldwide. One of the most compelling aspects of this development is the cost effectiveness. Stark highlighted the sharp contrast between traditional financial systems such as Visa, where fees can soar as high as 3%, and the Lightning Network, where fees for transacting are significantly lower. This affordability factor could democratize global transactions, empowering individuals and businesses alike. As Lightning Labs continues to refine its protocol, the prospect of stablecoins seamlessly integrated into the Bitcoin network beckons a new era of innovation and accessibility in the digital asset sphere. Stark reaffirmed this sentiment, stating, "That's why we're building this protocol, this technology right now. We're not issuing assets, we're building the rails. Asset issuers will use our technology to issue real-world tokenized assets." The integration of stablecoins onto the Bitcoin network marks a monumental stride towards democratizing access to digital assets led by Lightning Labs. This initiative underscores the transformative potential of Bitcoin and the Lightning Network in fostering financial inclusion and empowerment. So it's interesting. It's true. A lot of people in countries with hyperinflation tend to gravitate towards stablecoins, particularly dollar stablecoins, because they fluctuate less, even though the dollar is also a depreciating fiat currency. It's people prefer that. They will hold Bitcoin too, but a lot of times they don't want to own Bitcoin only because the fluctuation in the value of it. So on the one hand, having stablecoins there's an established use case for it, and most of them are on the Ethereum network. Some of them are on some of the other networks. So having that on Bitcoin obviously makes a lot of sense, on working on the Lightning network. But on the other hand, some folks would say, well, you already have Lightning and you can use Sats and, so on and so forth. So why not just keep it Bitcoin only? But again, it's a free market, and the market is going to speak what it wants or doesn't want. So anyway, it's good to see development. It's good to see people thinking about this and trying to leverage Bitcoin in new, unique ways. And we'll see. We'll see what the market likes or doesn't like about that. Okay, next up is from No Bullshit Bitcoin. This was posted on May 8th. Articles entitled AgoraDesk and LocalMonero P2P exchange to shut down on November 7th. After almost 7 years of operation due to a combination of internal and external factors, we have made the difficult decision to close our platform. We're extremely thankful for the love and support we've received over the years. We couldn't have done it without you. We love you all, announced the project. The winding down process begins today and finishes 6 months from now. Our support staff will be available to help throughout the period. Existing users should be aware that effective immediately, all new signups and ad postings are disabled. 1 week from now, on May 14, 2024, new trades will be disabled as well. 6 months from now, on November 7, 2024, the website will be taken down. Please reclaim any funds from your arbitration bond wallet prior to that date. Otherwise, the funds may be considered abandoned or forfeited. And so that's a bummer. You don't really want to see peer-to-peer networks going out of business, but thankfully there are plenty still around, and hopefully, like I've used Bisq before, which is great, and there are others. So hopefully those continue to operate, because being able to buy and sell Bitcoin peer-to-peer is going to become more important, particularly as governments try to crack down and close the ons and the off-ramps. Next is also from No BS Bitcoin. This is posted on May 4th. OpenSats receives additional $21 million funding from Start Small initiative. We are thrilled to announce that OpenSats has received an additional donation of $21 million from Start Small, Jack Dorsey's philanthropic initiative announced OpenSats. This donation will top up our funds and operations budget with $15 million going to our general fund, $5 million to the Noster Fund, and $1 million to our operations budget. We are incredibly grateful for the massive support we've received in the last 18 months, and we hope that other philanthropists will join in so that OpenSats may remain an effective public charity for many years to come, added the organization. If you want to support Bitcoin and the broader freedom tech movement in general, be sure to donate to one of OpenSats' funds. If you're an open source developer in need of funding, they have a link to apply and learn more about all the initiatives supported by Start Small, and there's a link. And Jack reposted a tweet from Edward Snowden that said, "I've been warning Bitcoin developers for 10 years that privacy needs to be provided for at the protocol level. This is the final warning. The clock is ticking." So I guess Jack is putting his money where his mouth is. And so you gotta love it. And then finally, this week, I wanted to cover a piece in Bitcoin Magazine. This was posted on May 3rd. 6 reasons to own Bitcoin in retirement. Something near and dear to my heart, something I've written about extensively on my blog, something that I practice personally. I call it the Bitcoin Retirement Plan. So with that, let's jump in. For newcomers, especially those in and around retirement age, the idea of investing in or owning Bitcoin can evoke reactions from skepticism to disbelief. If you look beyond the popular narratives, however, you might find there is more to the story than first impressions suggest. Here are 6 reasons to consider owning at least some Bitcoin during retirement. Traditionally, investors use a strategy called asset allocation to distribute and shield funds from investment risk over time. A sound asset allocation strategy is the antidote to putting all your eggs in one basket. There are several types of asset classes or categories over which to distribute risk. Customarily, advisors seek to establish a dynamic mix between debt instruments like bonds, equities like stocks, real estate, cash, and commodities. The more categories you employ to distribute your assets and the less correlated those categories are, the better your chances of balancing your risk, at least theoretically. Recently, due to unintended consequences caused by the aggressive expansion of societal debt and the money supply, assets that were previously less correlated now tend to behave more in kind with one another. When one sector gets hammered today, several sectors often suffer together. Regardless of these present-day conditions, asset allocation remains a well-conceived strategy for moderating risk. While still in its relative infancy, Bitcoin represents an entirely new asset class. Because of this, owning at least some Bitcoin, especially due to its distinct properties when compared to other cryptocurrencies, provides an opportunity to broaden your asset base and more effectively distribute your overall risk. And then the second one here is Bitcoin offers a hedge against inflation and currency debasement. As a retiree, protecting yourself from inflation is crucial to preserving your long-term purchasing power. In the asset allocation discussion above, we referenced the recent and aggressive money supply expansion. Everyone who has lived long enough to approach retirement age knows that the dollar no longer buys what it used to. When the government issues large amounts of new money, it debases the value of the dollars already in circulation. This generally pushes prices higher as newly created dollars begin to chase the existing limited supply of goods and services. Our own Parker Lewis touched on this extensively in his Gradually Then Suddenly series. In summary, when trying to understand Bitcoin as money, start with gold, the dollar, the Fed, quantitative easing, and why Bitcoin supply is fixed. Money is not simply a collective hallucination or a belief system. There is rhyme and reason. Bitcoin exists as a solution to the money problem that is global QE, and if you believe the deterioration of local currencies in Turkey, Argentina, or Venezuela could never happen to the US dollar or to a developed economy, we are merely at a different point on the same curve. In contrast to fiat currencies, no one can increase the supply and arbitrarily reduce Bitcoin's value. There are no centralized authorities that govern its monetary policy. Despite arguments to the contrary, Bitcoin is similar to gold, but not exactly, because gold miners continue to inflate the supply of gold each year at a rate of 1 to 2%. As Bitcoin is slowly introduced to the circulating supply, i.e. mined, its inflation rate decreases and will eventually cease. This fact makes Bitcoin uniquely scarce among global monetary assets. Ultimately, this scarcity, along with Bitcoin's other monetary properties, should safeguard its purchasing power. As such, owning Bitcoin during retirement offers you a hedge against inflation. Number 3, Bitcoin offers an opportunity for asymmetric returns. Bitcoin's capacity to mitigate many of the challenges we discuss here rests on its ability to achieve asymmetric returns. Its supply is fixed, there will only ever be 21 million Bitcoin, and demand for the asset is growing steadily. As this limited supply collides with increased store value adoption from individuals, institutions, and governments, Bitcoin has the potential to dwarf the returns of nearly every competing asset class. It's worth noting that people generally improve their returns with Bitcoin when they hold it for the long term. In the modern era, retirements lasting decades or more are increasingly common. Over such time periods, even a limited allocation to Bitcoin offers ample opportunity to benefit from its upside potential. You just need time to hold through the short-term volatility, which, contrary to popular belief, is not evidence of it being a poor store of value. Sequestering a portion of funds solely for appreciation during retirement runs somewhat counter to conventional wisdom. Modern retirement planning generally optimizes for the liquidation of portfolio funds to provide income. However, setting aside a small amount of Bitcoin kept steadfastly gated from funds earmarked for income opens the door to benefit from the monetization of Bitcoin's limited supply. Number 4, Bitcoin offers protection from the risk of long-term bonds. Conventionally, high-grade bonds held directly or as fund shares make up a significant part of most retirement portfolios due to their low risk levels and tendency toward capital preservation. However, things have changed. Monetary expansion and increases in societal debt have forced bond yields, or the amount of interest paid, i.e. the coupon, to historically low levels. The yields on most bonds today fall well below the rate of inflation. This negative real yield means that owning a bond can cost you money, but the difficulty doesn't end there. Because retirees need funds from their portfolios to pay bills, they generally must sell assets at current market rates to derive income throughout retirement. In the case of bonds, at present, this can be very problematic. Consider the following equations. How much money does it take for a bond paying a 2% rate to yield $20? Answer, $1,000, which is 1,000 times 2%. How much money does it take for the bond paying a 4% rate to yield $20? Answer, $500. 500 times 4% equals $20. These two equations reveal that to yield the same $20 return, the market value of the underlying bond changes based on the interest rate promised. When interest rates go up, the market value of the bonds goes down. When interest rates go down, the market value of bonds goes up. The market value of bonds has an inverse relationship to interest rates. Consider that interest rates today hover near historic lows. Over the next 20 to 30 years, what will happen to the market value of bonds held by retirees if interest rates increase substantially? The answer, the market value of the bonds will collapse. This changes the entire risk paradigm for bonds and retirement portfolios and potentially makes them far less safe than typically imagined. Bitcoin exists in a separate asset class from bonds. It is a bearer instrument that is not exposed to the same money market risks. As such, owning Bitcoin may help you offset at least some of the potential risk incurred from owning bonds in retirement. Number 5, Bitcoin offers a potential solution for long-term healthcare risk. Another area of concern for retirees is the cost of healthcare. Here I'm not referring so much to ordinary medical bills, but rather to the potential to incur long-term care expenses in later age. Insurance is available for long-term care, but it has some unique and increasingly difficult challenges to overcome. Healthcare in general takes a double hit when it comes to price inflation. Not only do healthcare costs rise due to monetary debasement, but healthcare faces additional headwinds from demand spurred by growth in the aging population. States regulate insurance for long-term care. To keep policy owners safe, insurers face scrutiny over where and how they invest policy premiums. To preserve capital required for future claims, insurers generally rely on low-risk, intermediate, and long-term bonds. However, as our discussion above on bonds reveals, low yields and the potential for rising rates complicate this practice. One immediate fallout is that premiums for long-term care insurance policies have risen substantially. We noted earlier Bitcoin's usefulness as an inflation hedge and its potential for long-term price appreciation. As it relates to long-term healthcare, it may make sense to set aside some Bitcoin explicitly dedicated as a hedge for this rapidly increasing expense. Number 6, Bitcoin offers you individual sovereignty. The final reason we'll consider for owning Bitcoin in retirement is that it offers you increased individual sovereignty. Bitcoin provides you a level of ownership that is not achievable with other assets. It can easily be carried across borders with a hardware wallet or seed phrase, for example, or transferred peer-to-peer anywhere in the world at low cost. If you hold Bitcoin securely in a wallet you control, no central bank can steal the value of your Bitcoin by printing it into oblivion. No CEO can dilute its value by issuing more of its shares, nor can a bank arbitrarily block access to or confiscate your funds. Unlike centralized financial custodians, which can be ordered to freeze or withhold funds on the whims of a government or other third-party authorities, Bitcoin with keys properly held is resistant to these kinds of overreach. Specifically for retirement purposes, you can also hold your own keys for Bitcoin in an IRA. Products like the Unchained IRA are a robust tool for building and saving your wealth on a tax-advantaged basis. And holding your Bitcoin keys in the form of a multi-sig collaborative custody vault allows you to eliminate all single points of failure while you do so. Benefiting from Bitcoin does not require committing to wild speculation or thoughtless abandonment of sound financial principles. In contrast, the more you look at Bitcoin through sound financial principles and apply them to your thinking, the greater the opportunities it provides. One steadfast financial principle that coincides with Bitcoin ownership is prudence. Macroeconomic investment strategist Lynn Alden often speaks of establishing a non-zero position in Bitcoin, i.e. owning at least some. The risk of losing a few portfolio percentage points in a worst-case scenario is, in my estimation, worth the potential upside. But to be clear, each person's situation is unique. You must do your own research and make the best decisions you can about what works in your particular scenario. So great piece, totally agree. Very helpful outline of why you want to have Bitcoin for retirement. So good stuff. Okay, and then before we wrap up, I did want to mention this week's featured post on the Bitcoin Fortress newsletter entitled Bitcoin, Championing Freedom and Liberty in the Digital Age. So check it out. I will include a link in the show notes along with links to all the other materials that I went over today. And with that, I will thank you for listening to the podcast this week. If you enjoyed the show, please like and leave a comment. Also, don't forget to subscribe on your favorite podcast app so you don't miss an episode. I like listening on Fountain, where you can earn sats for listening. You can also follow my Substack. It's at bitcoinfortress.substack.com. It's free, but if you want to subscribe and help support me, that's welcome. But all my posts are free. And you can follow me on Nostr. My NPub is included in the show notes. I'm not on any other social media, Nostr only. And with that, I will talk to y'all next week. Bye-bye.